Hello folks, Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of three different market timing reports for the S&P 500 for advanced options traders. This will be for Friday, June 29th, getting ready for July 2nd, 2018. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All three reports look at the current market condition. We had to alter it a little bit this time to accommodate the nature of this, just to get the the sample size a little bit higher than where it would have been using a 50-day moving average. So we have a downswing bar on Thursday, followed by an upswing bar on Friday. That's the price action that occurred above the 100-day simple moving average. In terms of the stochastic situation, and this is what really limited the sample size here, is that we are between 0 and 40, trending above percent D, the 3-day simple moving average. So that all combined makes for about 46 occurrences of this market condition since January of 2000. Okay, so with that in mind, let's go to the market reports. Specifically, first, the Condor and Butterfly timing report. Since January 2000, we've had 4,660 daily closes of the S&P 500. Of those, 65% have been favorable bars for selling premium, where the actual 21 bar movement was less than what was being implied by the option prices measured by the SIBO's skew-adjusted VIX. Okay, so once again, almost 2/3 of the bars in the S&P 500 since Jan of 2000 ended up being favorable bars because the subsequent 21 bar movement was less than what the options prices were implying about the future movement. Okay, now that's the baseline. As I mentioned, also since Jan of 2000, our current condition has occurred just 46 times. Of those 46 occurrences, just 56.5% of the bars were favorable for option premium selling. That's a bit less than our benchmark. It's about 8.5% less. Okay, so statistically, it's more likely than usual that our current market condition will end up being an unfavorable one, unfavorable for market neutral option premium selling. Okay, that's the Condor Butterfly timing report. Going to the bull put spread timing report, where we presuppose that the trader is going to sell put premium, a standard deviation out of the money, 30 days out in time. Given that, as I mentioned, we've had 4,660 closes of the S&Ps. Of those, 83% turned out to have been favorable for selling puts like that, with the actual 21 bar downside movement going towards those out of the money puts. Okay, that movement was less than what was being implied by the SIBO's skew-adjusted VIX, the implied movement to the downside. All right, so that's the benchmark of 83%. Now, of our 46 occurrences since Jan of 2000, okay, of those occurrences, 73.9 were similarly favorable. That's a bit less than the 83% benchmark. So we have a put premium selling edge that's negative of 9.1. Doesn't look so good. So statistically, it's more likely than usual that our current market condition will end up being an unfavorable one for selling out of the money put premium. Okay, so let's moving on finally to the market likelihood report. What we do is we look at the rates of change. You take a close and then you go forward 5, 10, or 15 bars, and you just see how much the market moved over the course of 5, 10, or 15 days. And of the 4,660 occurrences of the S&Ps, you could take any close, go forward 5 bars, and on average, you would have a change to the upside of about 0.1%. And that's, you can see that right up here. You see that? Rate of change, 0.10. That's the benchmark rate of change because the market's gone up since January of 2000. Okay, on average about 0.1%, tenth of a percent every 5 days. Every 10 bars, it's gone up 0.2 or about a fifth of a percent. Every 3 weeks or 15 bars, 0.29 of a percent. That's the benchmark change. Now, when we go to our 46 occurrences, okay, of those 46 occurrences, the average 5-day change is at 0.33, much greater than 0.1. Okay, and that's a difference of about 0.22. How significant is this, though? That's the question. I mean, it's a lot more to the upside, but is that significant? Well, what we do is we take this difference of 0.22 and divide it by the standard deviation of 0.81. And so really, we want to know about this difference. How much, if this difference is a huge, if it's a big deal, it's going to be a substantial portion of a standard deviation. It turns out to be something just above a quarter of a standard deviation to the upside. Nothing too much to write home about. Okay, in fact, the others are, definite bias to the upside, 0.34, 0.27 of a difference. The z-scores, though, again, are not even a third of a standard deviation to the upside. Not even a third of a standard deviation to the upside. So consistent, bias to the upside, but not by that much. Not, even fails to make a third of a standard deviation to the upside there. Now, we divide these 46 out into those where the subsequent day the market went above Friday's high in this case, and also below Friday's low. And so in the 30 instances where the previous day's high was exceeded, like Friday's high in this case, of those, you have a z-score, a 5-day z-score of over half a standard deviation, 0.66, about 2/3 of a standard deviation to the upside. So that's something to sit up and take notice. If the market goes up above Friday's high, okay, in terms of the short term, you have a historical behavior that's fairly significant, over 2/3 of a standard deviation to the upside. Going further out in time, 10 and 15 bars, now it gets down to about a third of a standard deviation. Once again, kind of flounders a little bit more, but still consistent bias to the upside. Of the 9 times that the market went below, in this case, Friday's low, you have z-scores that are, again, pretty flat, not even a tenth of a standard deviation in either direction for the 5 and 10. And 3 weeks out, we're barely even at a third of a standard deviation to the upside there. So now let's look at volatility. The benchmark market volatility since Jan of 2000 is between 15 and 16% here. Okay, of our 46 occurrences, the average realized volatility is right around 14%, a bit less than the benchmark, baseline realized volatility of the market. Now, when you divide that out, if the market goes up, you have above Friday's high. Now we're in the 13s. And then if it goes down, look at that, the 9 times that it went down below Friday's low, then realized volatility is significantly greater. Look at that. Wow, that's a big deal. Big deal to the downside, where you're looking at realized volatilities much greater than what the VIX is at, or even the short day VIX as well. See that difference right there? 19.7, we're looking at 18 to 19% realized volatility, and the VIX here is at 16. So I think if the market goes above Friday's high, certainly you're looking at a likelihood of lower market volatility in that case, okay, than if it goes down below Friday's low. Big pivot point there in terms of what the future realized volatility of the market is, okay? I hope this has been of some assistance. Thanks so much for joining us. Have a good week trading. Bye-bye.